All right. So why are we here? So the idea of this specific lecture, well, let me start with this. I want this to be interactive. So please feel free to ask questions, raise your hand if anything comes up that sparks your interest. I don't want to just be talking to you. Tony's got a number of different polls to keep you alive and awake and engaged. So we'll definitely keep you on your toes in that way. But if other questions come up, please feel free to ask. The other thing I want to say is this is a brand new presentation. I've never given this, so you cut me a little bit of slack because you guys are the guinea pigs for this presentation. Hopefully next year's group will get a streamlined, more condensed version of it. And if we run out of time, I do want to leave time for Q&A at the end. And so if we don't get through all the slides, happy to send them out later on, and so that you can take a look at anything that we didn't cover. So the title is a 48-hour investment process. And that while that may sound a little bit arbitrary, I will explain what that means in future slides. We will be briefly discussing some securities in this, and just remember that none of this is advice regarding purchasing or selling securities. So here's the overview. There's an asterisk there next to the overview, and that's because this is a very text-heavy presentation. I apologize for that. My wife is the one with the cool graphics and pictures and stuff like that. That's her expertise. I'm trying to give you a checklist for how to conduct a very brief, you wake up and you have a job interview and they give you a stock and you have 48 hours to look at it. That's the title. How do you do that? How would you go about it? And so that's part of it, and that's A. And then B, if you do have more time, whether you're working in investment management or you're working in investment banking and you have more time, what other resources can you access? And I think, especially for young investors, it's very important to utilize checklists and have a holistic sense of all of the resources that are available to you when you're doing research. And so we're going to go through that over the next couple, hour and a half. We're going to talk about why this matters to you. Bill says you always give people context. So I'm going to go through a couple different scenarios that will make this a little more real for you, like why this presentation will be helpful for your careers. And then the bulk of the presentation is a checklist on how to get up to speed quickly on a company. And we're going to talk about Cove Street's 3 pillars: business, value, and people. I don't think not everybody uses these terms, business, value, people, but honestly, they are the 3 main pillars of any analysis of a company. So people use different acronyms and different ways of looking at it, but essentially it's always comes down to business, value, and people. And then, under the scenario in which you're tasked with making a recommendation of some kind or giving somebody guidance on a company that you've only had a short period of time to look at, I want to talk a little bit about how to think about doing that. And then we'll move into a couple slides on other avenues available to you if you do have more time. So, this 48-hour process is kind of a quick and dirty, what can we do? I think these are things that you would do anyway, but it's a little bit of a truncated experience, and there's a lot more you can do if you have more time and resources. And then key takeaways, and then we'll do some Q&A. So here's a little bit about myself. You already know about me. I'm a portfolio manager at Cove Street. I've been there about 10 years now. It'll be 10 years in July, which sounds like a really long time. Feels like a really long time. But I've been in the business since 2007. So I just want to make sure everybody has a little bit of context. If you don't remember a little about anything about Cove Street, I just want to, in any time you see someone's presentation, it helps to understand their process, because it will, it'll fit within what we'll talk about will fit within this process. So we're fundamental value investors. When we say research driven, that means we do a lot of work on our ideas. We concentrate on our best ideas. That's 20 to 30 stocks in the strategy that I co-manage. And in our classic value small cap strategy, that's 30 to 39 stocks. So in every strategy we run has fewer than 40 stocks. Everything we do is based on this Buffett versus Graham framework. We categorize all of our companies on a 1 to 4 basis, with a 1 being a true Warren Buffett stock, think a compounder, things that are getting more valuable every day, and then a 4 being a true Ben Graham stock, which is a cyclical business that is, has returns lower than its cost of capital. And then every other company fits in between those. We think and act long term. When everybody else is focused on next quarter or next week or next year, we're trying to think 3 to 5 years out. We hold, our hold periods are pretty long. Ideally, we'd invest in stocks forever. And that's our goal, is to find companies that you don't have to ever sell, because you want to take advantage of the mathematics of compounding. You want to hold something in a tax efficient way, and let the business get more valuable every day. And you don't have to do any more work. The management team is doing all the work for you. Less is more. Everything that we do is less is more. That's fewer stocks, fewer new ideas, fewer companies overall that are within our investable universe, just focused on things, on the best ideas and the kind of companies you want to own. And so we asked 3 questions. Is this a high return company that is getting more valuable each day? Is this company run by honest people who understand capital allocation? And is a stock undervalued based on conservative assumptions about the future? So all of the things we're going to talk about today are kind of encapsulated within this investment philosophy. So let's talk about why we're here. So I'll just give you an example. I had a friend who just got a job at First Pacific, which is a pretty large asset manager. I guess it's West LA is where their office is, not so far from campus. And they said, hey, here's Big Lots, ticker BIG. You have 48 hours, turn it around, tell us what you think. And he'd never looked at a retail company before. So he called me. I was on vacation actually. And I spent probably 90 minutes on the phone with him, helping him understand, how to look at a retail company. But this is a real life scenario. Like, I don't know how many of you are going into investment management, but if you're looking for a job, this is the kind of thing that's going to happen. They'll ask you to look at a stock over a short period of time. Maybe it's 48 hours, maybe it's a week, maybe it's 2 weeks, but you still have to run a process, and you still have to run an efficient process because you don't have that much time. And even if you're going into investment banking, for example, having an expedited process to get up on a company is really helpful. So I think this will be applicable regardless of what your career aspirations are. And then even more importantly, so much of investing and being in investment management and investment banking is figuring out what you should spend your time on. And if you have a short process by which in 48 hours you can decide whether to spend more time on something, that's a really good way to figure out where to allocate your scarce resources. So I think as more than anything is having a process that allows you to figure out what you shouldn't be spending time on. And you'll be honing your process your entire career. So this is just a step towards that, is like making it efficient, using checklists, doing it in a way that's systematic and not just like, kind of floating between task to task. The more efficient you are and the more, targeted in your research, the more effective you can be. And I will say this is my personal sense of what you should do in a 48-hour period or whatever, a week period. Other investors might have a different process or different things they focus on. So remember that, right? This is just an example, but I do hope that there are some elements that you can take away from this. So one thing to do before you start anything in life, as opposed to just diving in head first, is to take a step back and think about what the purpose of the process is. So we're going to talk a little bit about what this would mean in the job interview context, and what this would mean, in a new project at work, if you are working in investment management or banking, or if you're just looking for investments for your personal account, or if your cousin or your sister is going to start work at a public company, and he or she wants to know, is this a company I'd like to work for? How do they treat their people? Is it in a good market? I don't really know how to look at these things. I need help. Well, this kind of analysis will be helpful for you. And then also think about what your own personal objective is, right? Are you getting a job? Are you looking at are you trying to impress your boss or colleagues? Are you trying to improve your process overall? Or are you trying to make money on your own, right? Think about it as you think about this process. Think about what your personal objectives are. And then, assuming that you're going to present to somebody or convey information to somebody, think about what this other person is looking for. So Tony, you're going to throw up the first poll for us. Got it. So a lot of people interested in banking. That I anticipated that. I do think that what we're going to go through today is going to be helpful, whether you go into investment management or banking or even consulting, depending on who your client is. So I'd like to think that this process, not only for this educational purpose, as you know, as you're in college, but also for your career, I'm hoping this will be a helpful discussion. So let's say you're going to go to a job interview. The first thing you need to think about is, so let's just say you're going through the scenario that I presented to you. You're going to go into an investment management role. That's your goal for a job, and you have an interview, and you get through the first round, and they give you a stock, and they say, hey, turn this around in 48 hours. So how should you think about that? Again, this is taking a step back before you dive in. My sense is that you're unlikely to make an investment decision based on your work. I mean, I'm a little biased here, but we often spend weeks or months or years on stocks before we make investment decisions. So I just don't think anybody in 48 hours or 70, even a week or two should be, comfortable enough making an investment decision. So remember that. So then if that's the case, what is a counterpart looking for? They're not looking for a full analysis and a model and a recommendation, right? They want to understand how you think about investing and what does your process look like. And my hope is that by giving you these tools, your process will be really effective and impressive to other people. And if they are looking for a recommendation, that's kind of a red flag. That sounds like a really strange expectation for someone who's never looked at a stock, and then 48 hours you have to make an investment decision. So what do they want to know? Do you have the skills and knowledge and passion to contribute? Do you think like an analyst or a portfolio manager? My thought is that you should always think like a portfolio manager. And let me describe a little bit about what that is. The traditional analyst role is you do a lot of work, and you do a write-up, and you hand it off to a portfolio manager, and that person makes the decision. And your work and your thoughts are taken into consideration, but you're not the end decision maker. So you kind of, in a way, are just information providers. But I think to be a really good analyst, you also have to put on that PM hat, and you have to think to yourself, like, how would this fit into our portfolio? Is this the kind of company we want to own? What position size makes sense? So go beyond just thinking about providing an analysis and thinking about portfolio construction and how it would fit within your firm. And then, and one other thing is they're trying to figure out, is there anything unique or special about you? And how do you, and I think you can evidence how special you are and how different you think based on your process. And so a couple other things to always keep in mind, and you're going to see this on the next slide as well. But for me, business value people is always a good framework from which to start. So as you're doing an analysis of a company, think in that framework. And especially in a short period of time, thoughtfulness is way more important than precision. You don't have time to be precise, but you have time to be thoughtful about your analysis. And curiosity is better than certainty. Nobody likes to see someone who thinks they know everything about a company in 48 hours. It's about curiosity. And then also, often we ask people, okay, we've given you the stock, you had a week to look at it. What else would you do with your time if you had another week or 2 weeks or a month? What would you do? So you should have a creative answer to what other research you'd like to do. And then be creative, right? Even if you only have 48 hours, call the IR people. Message someone on LinkedIn and just say, hey, I know there's a really weird request, but I've got to turn around a stock in 48 hours. Is there a way you could spend some time with me? And you know what? It's amazing how many people will, especially if you're in school, someone will comply with a request like that. So that's a job interview scenario. The other one is a new project at work. So how can this process help you if you're starting a new project at work? You already have a job. Like, how is this process going to help you? Well, again, if someone asks you for a quick read on a company, spend a couple days on it and come back to me, what are they looking for? Well, again, they're not looking for a full analysis, model, recommendation. What they're trying to figure out is, should we spend more time on this company? Is it a Buffett or a Graham? Is it a, you know, a compounder that's getting more valuable every day, or is it a cheap, statistically cheap security that, you know, you can benefit from mean reversion, where, you know, it's just cyclically hated, and you know, it'll get a cyclical bounce sometime and you can sell it then. And you also want to be able to convey, do we have the internal ability to develop an edge, right? And so your work is trying to figure out, like, do we have the capability to analyze this company as a firm, and then do we have the ability to develop an edge? Also, like, what other research outlets are there for us? So kind of same question, like, what else would you do if you had more time to look at it? And then I continue to think, like, everyone, whether it's a job interview or whether you're already working there, think like a portfolio manager. How would the stock fit into the portfolio? And then business value people, and then, you know, be thoughtful and curious. Tony, you want to throw up number 2? So 82% of you are you know, think that the business is the most important. I would agree with that. I think, you know, the value and the people are incredibly important for making an investment decision. But when you have a short period of time, right, and you're trying to understand, you know, what this company is and does, I think you have to start with the business. And so that's where, you know, that's where we're going to start. But before that, just some process advice. And I think this is something that, you know, I've developed over a really, you know, over 15 years of trying to figure out, like, how best to start a process, how best to evaluate a company in a short period of time, so that you can kind of get a sense of what you're looking at. So me, if anybody knows anything about me, I'm crazy about taking notes. You know, it's one of the reasons why I'm in the seat today, is because I was the guy who was crazy enough to try to take down all the words from the Berkshire Hathaway meeting. So I'm all about taking notes, but I think it is a huge part of your process. I don't understand people who just read stuff and K's and Q's and presentations and don't copy and paste things and clip things, because then you don't have a central repository for all the information, and then you're just relying on memory. So I don't do that. Take notes. You'll want to refer to things that you come across, you know, copy and paste charts, write down questions that come up, just be meticulous in your process, because I do think that most employers, whether you're working for them or you want to work for them, want to see a level of meticulousness in your process. And then within that, think about the 4 key variables that will determine the success of the investment. 4 is not a magic number. That's a number we use. It could be 5, it could be 3, but always be trying to take your head out of the, you know, kind of the weeds as much as you can, and think about the higher level. What are the main, what are the main things that are going to drive this company over the next 3 to 5 years? And have a game plan that starts with a checklist. And so I like to think that this presentation, plus the assessing management presentation that I gave, is a really good start. Like, please steal liberally from that, right? As you're developing your process, and you don't want to have to think about what the next thing you have to do is, use someone else's checklist. And if you can get access to a high quality data site, CapIQ, Bloomberg, FactSet, it's really hard. And it's a little bit of a barrier to entry for students, but it's really hard, I think, to be able to show your skills and to, you know, really have an efficient process, unless you have good data. So whatever it is, borrow it from somebody, you know, do whatever you can to be able to get data. And then recognize that in a short period of time, you're never going to know everything or understand every detail, right? It's not about precision. It's really about how you think about investing, what your process looks like. So don't be too worried about, you know, knowing everything, because you never will. And then always keep in mind business value people. All right. So let's start. Let me stop there before we get into the business side, because this is going to be the meat of it. Any questions that have come up, you know, as I've kind of laid out the game plan here?
Yeah, I had a quick question. So When you say that you should rely on these databases, when you're doing your valuation analysis, do you find yourself relying more on just looking straight at from the 10K or more on these like CapIQ or something like that?
Um, so I would say in the first look at a company, I will look at the multiples tab on CapIQ or Bloomberg. I'll see where, where it's traded historically, and this is like before you actually like start diving in. But then once we actually start our process, and we'll go through this on the valuation section of this, it's really coming off of our spreadsheet. So, you guys are going to be doing DCFs, your entire life, as long as assuming you're in banking or, or in investment management, you're going to be doing a lot of DCFs. So everything we do, it emanates from that. So the simple answer is, when you're doing the flyover of a company, it's okay to look at the CapIQ multiples. But especially since your valuation is going to be determined by what the future looks like, not what the past looks like, you have to incorporate your DCF and your, as if you're doing a multiples analysis or you're doing some of the parts, whatever you're doing, the DCF is kind of the core to that. Is that helpful?
Yes, thank you.
All right, so let's talk about the business. Assessing businesses is core to any investment process, and there are a million different ways that you can think about a business and the questions you can ask. So, but I came up with 10 questions, and there's nothing magical about 10. There's probably 10 more, or you could cut it down to 5. But my point is, this is a pretty good list of things that you should be able to answer before you feel confident, A, making a recommendation, but B, even understanding whether you should spend more time on this company. So let's go quickly through these, and then, please feel free to stop me if you have any questions on it. But first off, how does the company make money? And I know that sounds kind of like trivial and maybe like an obvious thing, but really you want to be able to describe to to yourself and to whoever is listening to you, how does this company make money? Because yes, if you're Walmart, it's really easy to understand how they make money. But if you're a software company, or you're a medical device company, you may not make money in the exact same way in all your products, and it may look a little differently. So so drill down specifically on how a company makes money. And then an overview. What are the company's products and services? You should be pretty conversant by the end of this process in what are they selling? What is their competitive advantage? What are they what differentiates them? Who are the customers? This is one that I think is underappreciated. Is where does the company have to invest over time? Is that in SG&A? Is that in R&D? Is that in CapEx? Is it M&A? But what investment requirements does this business have from an ongoing basis and in order to grow? And then returns and margins are huge, right? Because this gets to the Buffett versus Graham. Is this a high return business that's getting more valuable every day, or is it a mediocre business that doesn't even generate returns above its WACC, right? So does it generate good returns and margins? What are the growth opportunities? Are end markets growing or shrinking? Where is there room to become more profitable and efficient? Companies will give you margin targets and return targets, but what is a path to that? How does a business finance itself? So does it finance itself using equity and cash flow, or does it need leverage? Right? You better really understand, as this business operates every day, how is it financing itself? And then, from this is, I think this aren't in any specific order, but this is probably the most important one to determining what kind of businesses it is. Does it have a sustainable competitive advantage that allows for either lower cost or consistent pricing? That's really key. If you can't answer yes to that, I would say you're looking at a Graham. If you can answer yes, then there's a chance it's a Buffett, right? So this is a very pivotal question, and it takes a fair amount of understanding of the industry and the company to get there. And then what are the main threats and risks to the business? I would say, these are not all encompassing, and there are other things, but I think this is a pretty good start. Tony, you want to put up the next one? So this is pretty good. I would say that those are good answers. And I will say, for the most part, I start with the 10K, but I do think at times when I'm trying to figure out whether to spend more time on a company, I will start with a presentation just to understand what they do. But I think you guys have it right. Start with the 10K to really, there's a lot in the 10K that is not that helpful, especially if you're running a quick process, but it will give you a pretty good overview of what the company does. So let's just go quickly. So this is it. This is the checklist. So you have a short period of time. You need to turn around a stock. And so what do you do? Right. So again, I'll just reiterate, you have a checklist of things that you go through, as efficiently and as fast as you can, I guess is the best way to put it. But you start with the 10K. As I said, it's almost always the best place to start, because you're gonna get a company overview. You're gonna understand the products and services. You're gonna get a little bit on differentiation and strategy. You're gonna see data on their end markets. You're gonna get an overview, at least a list of the competitors, and then you're gonna get a sense of customers and customer concentration, right? So, from just a really high level, what does this company do? Who does it compete with? What are its products? Like, this is the 10K gives you the best overview. Now, to some degree, the 10K is written for. Actually, I don't know who the 10K is written for. Certainly not written for somebody who wants to to articulately describe what the business does. So, the 10K is written in a legalese that is kind of not really that helpful in certain ways. Some companies are better than others, but you're going to have to add on, right? Because sometimes I read a 10K and I have to read it 2 or 3 times to figure out what in the world this company actually does. But it's a good start. Risk factors are another main section of the 10K. These are written by lawyers, and they put in everything that could possibly be a risk, regardless of how remote it is. So you have to read through them, but I look at this as you look for outliers. Look for things that are material, look for things that stand out, look for things that not every company puts in their 10K in terms of risk factors. MD&A is a management discussion analysis. This is a discussion of what's been happening over the last 3 years in terms of performance, and that's margins, that's cash flows, that's revenues, right? So this is just giving you a sense of what the recent history is. The financial statements, right? That you'll get a chance to walk through the financial statements. Cash flow statement is king in our mind, right? You can look at revenue and you can look at the balance sheet, but at the end of the day, for what I'm focused on is does this company generate cash? Is it consistent? Is it growing? Can it continue to generate cash? It, gets back to the qualitative side. Especially if you have a short period of time, I would say the notes are if you're getting stuck in the goodwill accounting or the revenue recognition, you're probably wasting your time, just because if you're going to invest in this company and you have 2 months to look at it, or you don't have a time frame, then absolutely you need to read through all the notes. And be really up to date on how they account for things. But I don't think in a short process is particularly helpful. But what is really helpful is to read the chairman or CEO letter from the annual report. And I think it makes sense to even go back, maybe do it for a few years and see if there's a consistency in terms of the cadence. They give you context on the business and the opportunities they see and the threats they see. See if that changes over time. See if management is consistent in the way they're talking about the business. From there, company conference presentations, as you guys highlighted, can be really beneficial. So you look at PowerPoints they do, and you read transcripts from sell-side presentations. I think those are really good ways to just get a sense. That's what we call the management pitch, right? They will pitch to you what they think about their businesses. They'll give you the bull case in almost all cases, and it's helpful to understand what management thinks about where the business is going to go. Company website. I think this is kind of underutilized, but honestly, the company website can have a treasure trove of information. You can have product demos, you can have tutorials, you can have interviews with product managers. There's all kinds of cool things on the company website. So seriously, don't forget to do that, because I think it gives you you become more conversant in the product set and the company's kind of ethos if you visit their website and you scroll, you go through it pretty extensively. So again, taking a step back, what you're trying to do is answer those 10 questions, and you're probably not going to get there yet. So you need to supplement what you're doing with easy to access resources that don't, that don't take that much time to go through. If you can get your hands on a sell side initiation, it can offer a pretty helpful overview of the company, but you just have to beware of their biases, right? They have a short-term bias. They have price and they have price targets that are probably a year out. They may have a different time horizon than you, but I do think it can help you understand the company. Maybe not from a really nuanced basis, but just from an overview basis. You should read as many conference calls as you can. Manage, any company that does conference calls, they're going to have transcripts out there for years going back. And so I do think you can learn a lot about the company from reading those transcripts. And then, if you're still having trouble figuring out what this company does or what their competitive advantage is, there are other places you can go. There are industry primers available. You can find them, whatever the trade association will put out some kind of industry primer. There are ways to learn about industry. Sometimes thoughtful investors will put out industry primers. That can be a good help, for the group that's working on Eric Spearon's project with the carbon offsets. Like finding an industry primer that talks about carbon offsets would be really helpful. And so that's an example of that. Write-ups from other investors. So Seeking Alpha and Value Investors Club, it can be helpful. I mean, you always want to do your own work. You always want to have independent thought. And so I think you should proceed with caution whenever you're reading somebody else's book, work, because, they're probably talking their book. They probably own the stock. So just recognize people's bias, and that, they're trying to sell you something to some degree. And then, you young people are really good at Googling, I'm sure. And so you can really find good resources, industry trade magazines and blogs and conferences. There are really good resources that are what we call non-Wall Street resources, where people really dive deep into industries and the competitive set and the opportunities and the threats. And you can, and it always helps to have either third-party validation or, refutation of what management's saying. And if you can find resources within the industry that kind of challenge or confirm what management's telling you, that can be really helpful in understanding whether, as you're developing your narrative. So let's say you've done that. Let's say, you're partially into your process. You've done all these things. What now? This is why I say you should take notes, because you need to. I don't think anybody can digest all that information in an efficient way that allows you to really create a good narrative and an understanding without, writing it down, taking notes, cutting and pasting, and then going back through them. Your pattern recognition will start as you start to go back through your notes and as you review the work you've done, because what you're doing, you're trying to create a narrative. And as an investor, you always have to have some kind of narrative about what the future is going to look like. And so by going back through your notes, I think it can help you start to create your narrative. And then see if you can answer those 10 questions. Go back to the checklist. And if you can, write down your answers. And then, maybe you'll go back later and see whether you were right or not, but see if you can answer those 10 questions. And if not, you need to find new sources to get your answers. And at this point, it's time to move from what I would call information gathering to critical thinking and analysis and skepticism. Let me stop there. That was kind of just the brief checklist. Obviously there's a lot more we could do, but I'm trying to give it to you in a kind of a quick and dirty. Let's get up to speed as quickly as possible. Any questions on what we just covered?
Ben, I have a question.
Sure.
And I don't want to cut anybody else off. So if there are questions, why don't you all go first? And then I have one question I'll then ask. Okay, Ben, you mentioned a moment ago that there's a point at which you begin to, I would say, morph or evolve into critical thinking. How do you decide that that's the right time? You get 48 hours. It's a little bit like, a multi-essay question on an exam, right?
Yeah.
When do you move on either because you're fearful about running out of time, or because you just feel like you gave a solid answer.
Yeah. I think for an experienced investor, the pattern recognition starts to kick in, and you start to develop a comfort with what you're seeing, and you're doing a lot of this in your head, and so I can't tell you when exactly I do a go versus no go on a company, right? Like I've done the first whatever day and a half, and what is a catalyst for me to say no, I don't want to go further, or yes, I will go further. It's really ingrained, and I'm not saying I'm always right, but there's really what I'm trying to do is use the pattern recognition to help make that decision. I think before you get to that point in your career, and hopefully for my career it just gets easier and easier, and then for Charlie Munger it's just second nature. But I would say go back to the 10 questions, and if you feel comfortable with these 10 questions that you can answer them pretty well, then you move from information gathering to critical thinking and thinking like a portfolio manager, and not just someone who's a provider of information. I think that's the best answer I can give, right? And the rest of it, it'll become almost intuitive and second nature the more experience you get.
That sounds fine, Ben. Are you going to talk about critical thinking? What are the aspects of critical thinking that you then dive into?
I'm going to cover that, maybe not directly, but you'll see, Bill, throughout that we will talk about that.
Okay.
So let's move on a little bit.
Absolutely.
So, and this is our bias and our frame a little bit, but I think you want to make a call. You need to get to a point where you can make a call on the business quality, right? So again, we just not to beat the dead horse here, but we have this Buffett and Graham framework that I think is really helpful. You don't have to call it Buffett and Graham, but are you investing in a good business getting more valuable every day, or are you investing in a mediocre business that's statistically cheap, right? And there's a million gradations within that, but just trying to get a sense of, like, is this a good business or is it not a good business? Because I do think that's going to frame the rest of your analysis, and it's going to frame the way that you approach, your counterpart as you're talking about this security. So, margins and returns, right? Does this company generate a return on invested capital greater than its WACC? If yes, by how much? And if no, why would it get better? So these are the things, and we're going to go a little more detail in the next few slides to assess the quality and make this call. There are a lot of tools at your disposal, but I do think from a high level, you want to be thinking about the whole time, is this a good business or is this not a good business? And so some of the things that you're going to look at as you dig further, barriers to entry, and is there a moat? Are there switching costs? Are there network effects? Capital, how capital intensive is the business? And really what you're trying to get down to, is this a Buffett or a Graham? And then for us, we layer on what's known as the CPEST analysis, which is climate, political, economic, social, and technological threats and opportunities. And so that's the macro side. Like, what are these things outside of the company's control that could be, either helpful or harmful? So, are they impacted by climate change uniquely, or is there some kind of regulatory / political threat that's looming over? Just like I think it was David who mentioned, that Biden's taking aim at the for-profit prisons. That would fit within the political risk. Is there economic risk, right? If there's a recession, does this business do poorly or does it do well? Social risk, right? I mean, is the move towards, I'm trying to think of what is the move away from people watching, cable television, right? That's a social risk for most of the TV companies, right? If everyone's watching Netflix and no longer watching the cable bundle, that's a social change. That is a problem for the TV companies. And the technological threats, right? Is this company highly at risk of technological disruption? Plus opportunities. So we don't spend a lot of time on macro, but we do try to look at, use this CPAS analysis to at least identify the, the risk that the company kind of can't control on their own. Another thing to think about, another question to ask yourself is the incremental return on invested capital high? And so what do I mean by that? So let's say a company's generated 20% ROIC over 10 years. And if you're an extrapolator, you would say, well, the future will be just like the past, and this company should be able to continue to generate a 20% return. But as you dig in, you'll try to understand whether or not the incremental dollar will get the same return as previous dollars. Or is there some disruption or some secular problem that's going to limit the returns on an incremental capital? Does the company have secular tailwinds or threats? Does it have cyclical issues? These are the questions that you want to be answering and writing down as you're trying to assess the quality of the business. And this is the most important for me, is can you say for sure that the business is getting more valuable every day? And there's a high bar for that. So it's not even, is this a good business or a mediocre business, but is it getting more valuable? And then another question to ask yourself is, the traditional, like if you couldn't trade the stock at all, and you just had to wake up and own it in 3 or 5 or 10 years, is this a business you'd want to own, right? Because that's what private equity does, right? They buy it and probably going to hold it for 7 years. So, you better believe you're investing in a good business. And then this is the key part. This is the takeaway. Ignoring valuation, because we haven't gotten there yet. So try not to get poisoned or by the valuation. But is this a business you would want to own overall? I think it's a really good framework to start with, because you can think about the people and you can start to think about the valuation, but really, is this a business, after you've done this work, is this a business you'd want to own? And so returns. So I'm getting into the nitty gritty here. Is like determining whether this is a good business or a mediocre business. So the basic question you're asking is the return on invested capital greater than its weighted average cost of capital? Because to me, that's the definition of a good business, if it can earn returns significantly higher than its cost of capital. And there are a lot of ways to calculate returns. You can do ROE, you can do a return on tangible capital. Our personal preference is a NOPAT over capital employed. You can do return on assets. Again, do you include the intangibles or goodwill or not? There's a lot of different metrics out there. And I was talking to my team about this just the other day when we were on, when we were talking about how to determine whether these software companies are good businesses or not. Is like, my advice is you have to use multiple metrics. Use ROE, use NOPAT over capital employed, find multiple metrics that are suggestive that this is a good business, because not every metric makes sense for every company. I gave my team an example of a company we're looking at that has negative 500 million in equity. So if you have negative equity, ROE is an irrelevant number, right? So because it's negative. And so it's not, you have to, my sense is that you just want to have as much evidence as possible that this is a good business. And try to figure out what's appropriate for the industry. Like return on assets is not particularly helpful for most businesses, but for banks, for example, it is a really important metric. And so this is my advice. If the returns are close to the WACC and it's consistently like that, I would err on the side of caution. I would assume it's a Graham until proven otherwise, right? Let the company and the management team and their results prove to you that this is a good business. Assume that it's mediocre and be pleasantly surprised. And then some of this, gets back to industry structure, which we haven't talked about, but is a really important component. And you're probably not going to get a lot of time to do a deep dive in industry structure. But there are some rules of thumb that I think you can take away. The more consolidated it is, duopolies and oligopolies, you're likely to see higher returns and margins across the industry. Less consolidated, you're probably not going to see the same high levels of return. You may see some really big winners, and then everyone else may not be, as profitable. But that means there could be potential room for consolidation, right? So can the company you're looking at be either consolidated by a bigger player or be the consolidator? And how ripe is the industry for disruption? Something to always think about, especially in the modern world where technology seems to be disrupting so many different industries. But these are, from a broad strokes basis, you should be able to answer, is this industry ripe for disruption or not? So the other thing to do, and we haven't talked about this, but doing some comparison with other companies can be really helpful. And this is why it's helpful to have a high quality data set, because you can very quickly compare the company's margins and returns to other companies. I'm not trying to play the relative game, just like this company is better than the other one, that means it's a good company. That doesn't necessarily make sense, but it is true that by comparing it to other companies, you can put the company in context. And so I copy and paste this from our spreadsheet for a company called Meredith, which is in the broadcast television market. And so, if you look here, I'm comparing the margins of, and not all these are perfect comps, but I'm comparing the margins of these guys to Meredith's local media division, which is in broadcast television. And so I'm just trying to put it in context. So use comparable companies, with either by segment or at the whole company level, to put your company in context and say, even if I do think this is a good business, it's the lowest quality business within the industry. Or on the other hand, it's in a kind of a mediocre industry, but it's by far the best business. So looking at competitors helps you put the business in context. Tony, you want to do the next poll? So 90% of you agree that the balance sheet is very important. I would highly agree with the statement. And maybe I worded it so strongly I led you to choose this one. But to some extent, it serves a purpose. Valuation is really important for an investment. The business is very important, but you can't ignore the balance sheet, because a bad balance sheet can turn a good business into a bad one, can turn good managers into terrible managers. And I always say this: an unlevered company cannot go bankrupt. Remember those words. The only companies that can go bankrupt are ones with leverage. So I'm going to give you a quick and dirty way of assessing the balance sheet. I think any investment professional that you talk to about a company is going to want to know what you think about the balance sheet. So hopefully this will give you a really quick way of doing a balance sheet assessment. So there are a few key metrics that we focus on: net debt to EBITDA, EBITDA to interest expense, and then EBITDA minus CapEx to interest expense are some that we use to try to assess the strength of the balance sheet. There are a bunch of other qualitative stuffs we look at, but those are like the three things that we would start with to say, all right, does this company cover its interest expense, with its EBITDA? Does it do it after CapEx? And then, what does its leverage look like on a net debt basis? But we're going to go into some more, but these are the kind of things that you want to go through as you're trying to assess a balance sheet. Assume that you're going to be asked about the balance sheet. And so here's what you want to be able to answer. Does the business generate cash consistently? What are the nearest maturities, right? So even a levered company, if their debt's not due until 2029 and they don't have any covenants, it's not really a big deal. Now, obviously, if it's like 20 times levered, it can turn into a big deal, but, because if they can't pay their interest. But, in general, you have to understand the maturities and the covenants to understand how big a deal the debt is. And do they have other funding requirements? Do they buy back stock? Do they pay dividends? Are they involved in M&A? Do they have legal settlements or environmental costs? Things that are like, not obvious, but could suck up cash. So these are the things that you want to be looking at as you're thinking about the balance sheet. And just remember that every company and industry is different. So the balance sheet risk is dependent on the industry, and it's kind of subjective. I'll just give you a quick anecdote, right? Like, real estate companies will have a lot of debt on them, right? And that's just the model, right? Companies, the real estate REITs often are 6 or 7 times levered on an EBITDA basis, or even more. That would be a lot of leverage for an auto manufacturer, for example, or for an auto parts supplier, because that's a cyclical business that doesn't have the cash flows can be quite variable, right? And so think about, within the context of the industry and the business, does it make sense to have leverage? and you can compare the leverage of the company you're looking at to that of other companies in the industry to get a sense of where they stand. But always put it in context. Like there's no such thing as a quote unquote bad balance sheet. I guess it kind of just depends on what kind of business you're in. And so this is, feel free to steal this if you like it. These are the questions that I ask for every company when I'm trying to determine, is the balance sheet a problem? And I'm not going to go through all of these. You're welcome to, I'll send out the slides, but these are the questions that I ask. And then I include potential offsets, right? And because, I think in my career, I've been a little bit too worried about debt. And of course you can say that because, almost no one's gone bankrupt since 2009, even during COVID. So debt hasn't been a problem for many companies, but, feel free to look through this and steal this list of things. But this is just me. But this is how I try to ask really specific targeted questions and almost quantify something that's unquantifiable. But the question is like, is the balance sheet really a problem or is it not? And I'll just give you some context. For me, a score above 5 here would be a red flag. And this company, I don't even know what company this was. I just copy and pasted. This one company's a 2. But if you see a lot of yeses here, they're at risk of tripping covenants, or there's a large amount of operating leverage, which means that their numbers get a lot worse if there's a downturn, or if they're committed to build a $100 million factory and they can't get out of it, and that's going to suck up cash, right? Those are the things you really want to think about in determining whether or not the balance sheet's a problem. So I hope I've given you some, quick and dirty ways of looking at the business, evaluating the balance sheet, looking at returns, getting to this question of like, is this a good business? Does it have a good balance sheet? Is it getting more valuable every day? Because these are questions you're going to have to answer before you get to valuation, before you get to people. These are the things I think you want to understand. So we're going to move on to value. And you're all very sophisticated quantitative investors, and you've done plenty of DCFs and you've taken, courses on this. And so I don't know how deep we should go. I don't know how deep we have to go into this. So I'm going to try to run through these slides quickly because I want to get to some of the takeaways. But please feel free to stop me if you think I'm going a little too fast. So first off, why is valuation so important? And this is something to keep in mind in any security you're looking at. As an investor, there's really only 2 things you can control. You can control your process and the price you pay. And so the price, if you look at any academic research, will tell you valuation really matters when it comes to future returns. And so if it really matters and it's one of the few things you can control, then without any question, you have to spend time on it, and you have to be thoughtful about it, and you have to be creative about it, because sometimes it's not always so easy to value companies, and you have to use multiple metrics, which we're going to get into. I also think valuation is a core skill of being an equity analyst, kind of par for the course. Even if you go into banking, you're going to be running spreadsheets, and you're going to be running, comparable multiple analysis, to try to figure out, what this company's worth, who what kind of acquisitions could it make? These are important things, even no matter where you go. I also think it allows you to deploy some creativity, especially within the discounted cash flow analysis. As you're creating a DCF, that's your painting. That's your Picasso, right? You have to be really creative, and you have to be humble, and you have to be conservative, and you have to be optimistic all at the same time, which is a really tough balance. And people don't think investors are creative. And I would take a look at it, one of my most detailed DCFs, and tell me that there's no creativity involved there. And then building consistency is the key to a good process. And so you want to have consistent framework from which that you use to value companies. And that's what we're going to go into right now. Tony, you want to go to the next poll?
That's a good question.
So about 3/4 of you, all of the above. I kind of gave you the answer. That is the right answer. Because there is no, unless you're a sell side analyst that only looks at PD, this is, you have to triangulate. Being a conservative value investor suggests that you want to find multiple metrics that suggest the stock is undervalued. So all of these are important for sure. No love for some of the parts though, but we will go through some of the parts analysis. But all of the above is the right answer, and we're going to go through those right now. So here's the ones we use mainly: DCF, historical multiples, sum of the parts, which is not so dissimilar from private market value. I'll discuss a little bit about the differences there, but the key idea is to triangulate. You want multiple metrics that suggest the stock is undervalued. But I will say this: there's no bell that goes off when you hit a stock's intrinsic value. Like there's no like light that comes down and say, look, this stock is undervalued. Right there, you have to do the work. You have to have multiple different ways of looking at stocks, and sometimes they may not all agree, right? And that makes it hard. But just remember that, like, it's what you're looking for is you're looking for as much confirmation as you can with as much data behind it. So the DCF, you guys are familiar with the DCF. I'm just going to go through some major things to remember about a DCF. So either you either believe that the value of any company is equal to the present value of its future cash flows, or you don't. We do. That's something we believe in. The DCF is a core part of our process. The difficulty is really in properly understanding what the future will look like. And so this is where you have to marry the quantitative and the qualitative and the business analysis with the valuation analysis, because you have to understand the business and whether or not it has a competitive advantage, and the total addressable market, and the returns on capital, and the margins, and the capital allocation avenues. You need to understand all of those things through your business analysis to be able to create a DCF that's worth anything, because otherwise you're just dragging across. And so remember, in any time you're looking at a DCF, it's garbage in and garbage out. You give me any stock, whatever you think it's worth, I can make it look cheap or expensive based on those assumptions. Right. And so remember that, right? Like, it's only as good as the inputs, and your inputs are only as good as your understanding of the business. And so that's why all of these things, business value and people, are all interrelated. And so just remember that, you can't separate these things in your mind. Understanding the business helps you create a better DCF. And just remember that multiples are simply shorthands for a DCF, right? And so, if you need a quick and dirty valuation metric, analysis, multiples can be helpful. And I added this to the presentation. There's a great presentation from an NYU professor on marrying the narrative and the model. Definitely worth clicking on, looking through his slides. He's like the guru of valuation at NYU. And so I just thought this would be kind of a fun way of driving home the point that this is all valuation is both qualitative and quantitative. I'm just going to go through this really quickly. We think about DCFs a little differently than other people do. And really what that is that we've hard-coded our risk-free rate at 5%. And so when the 30-year treasury is way below that, you look kind of silly because you're using weighted average cost of capitals that are way higher than other people. So if other people are really willing to underwrite an investment at a 5% WACC, and we're using a 7 or an 8, then we're not going to invest in that company, and someone else might. But the reason we do that, and I understand that other people don't, but the reason we do that is because we know what the long-term returns of the market look like. Right, it's 6 to 7%, is over the long term, maybe 7-8% if you're looking at like something like small cap. But our sense is that you want your, you want a return that in a WACC, which is in kind of an embedded return rate, you want it to be higher than the market returns. And it's funny because I was listening to a podcast with Joel Greenblatt where they do the same thing. And so, don't take it from me, take it from Joel. But the real idea is think about the WACC as a hurdle rate for an investment, not just like a really formulaic, thing. Think about, would I accept this return if this is the return you promised me? The two other things we do is we have a terminal growth rate at 0, which is also enormously conservative if you've ever looked at how terminal multiples look. If you add a growth rate to a terminal multiple, it really it inflates the multiple a lot. So, our methods are designed to be conservative, just because that's who we are. We're conservative and value investors, and we embed modest growth expectations, in years 5 to 10 as well. All of this is to say, you don't necessarily need to copy the way we think about this, but be humble and be conservative in your estimates, because you're gonna, if you're, well, we can talk about this a little more, but you're at risk of losing money the more aggressive you are in your assumptions. So I copy and pasted this. You guys have seen a lot of DCFs before, so I'm not, this is just the output for Western Union, which is one of the companies we own. Some of the things to note here is that one thing that I really like, and if you can ever get your hands on something like this is our sensitivity analysis here. And it's a sensitivity table that says, with a certain WACC and a certain NOPAT growth in years 5 from 10, what's the valuation? And so what I like to do with this is I like to say, well, what is the stock discounting now? The stock was about $24 when we looked at it, which was, an 8% WACC and a -3 NOPAT growth, which to me sounds like a really low number. Right. So what is the stock embedding? It's embedding a lot, us like permanent NOPAT shrinkage. So that's a pretty bearish view by the market. Now we have a slightly more aggressive view than that, but this is just an output of our DCF. We don't really need to go into it because I know you guys are experienced here, but I just wanted to copy and paste something so you can see a real world example of how we use it and the inputs that we're using. It always starts with NOPAT. That's really our kind of like, if you think about our key cash flow metric, we're always starting with NOPAT. So what do you do if you have to create a quick and dirty model, right? You have a short period of time. What in my estimation, what should you be modeling out, right? You don't have time to do like some very fancy 500 line DCF. So what do? I'll go through the things that I would think are most important. Start with the income statement, revenue, but not just this. I think this company can grow 3%. Try to find some metric that you can drive revenue from. So I love modeling companies that have subscribers, because you can look at subscriber, you can look at revenue per subscriber, and you can model those two things out. And revenue per subscriber is a measure of pricing power. So you measure subs, how fast can the subs grow, and how much pricing power does the business have? And that can get you, kind of your revenue number. And so, and that's a really easy version. Not every company has that, but if you can find something that to anchor your model to, and not just say, I think this company can grow 7%. Well, tell me how that works. Is that volume? Is that price? What is that? So the more you can include volume and pricing into your estimates, even in a short model, I think it really shows a very thoughtful process and a thoughtful analysis as well. Gross margins, as I was telling my team the other day about software companies, gross margins are really how you determine whether a software company is good or not. It obviously it all flows down to cash flow, and that's what's important. But gross margins can be at least a first barometer of like how good a business this is. Operating income and operating margin, obviously very important. We focus a fair amount on EBITDA because we do private market value and SOTP with EBITDA. So you have to have an EBITDA number and EBITDA percentage. We compare our companies across a competitive set on EBITDA margin, tax rate, and earnings per share, because if you're going to do any kind of P/E analysis, you need EPS. And then you move to the cash flow statement and depreciation, amortization, any required changes in working capital. So as this business grows, does it generate more cash from working capital, or does it have to consume cash? CapEx, and that's if you can figure out what maintenance CapEx is, try to separate and bifurcate maintenance CapEx and growth CapEx to the degree that you can. And then option expense, and why? Just because that's a non-cash expense and it's added back on the cash flow statement in full. And if you look at our NOPAT analysis, which is right here, this is just our convention. We only add back half of the option expense. We don't give the company full credit for it. But NOPAT is as I said, our shining light, right? Everything we do, all of our DCF is based on NOPAT. So for me, if you're doing a DCF and you're trying to, get to the NOPAT as quickly as possible, these are the variables you want to be looking at as you're doing the model. Moving to historical multiples. So really what this is where has this business traded at over time? Where does it trade now? And where do you think it's going to trade in the future? And so we use capital IQ to determine what we call the standard deviation adjusted average multiples. So what we do is if this business is traded at whatever 12 times EBITDA its entire life, and then for some reason in 2009 it traded at 25 times, we pull that number out and we adjust it so that we're not inflating the number based on like a 1-year aberration. And so we take 5 and 10 and 15-year average multiples, and then we take those multiples and we apply them into an EV to EBITDA, price to earnings, and EV to sales numbers. And so if you look at Washington Mutual, you can see, sorry, not Washington Mutual, Washington Union. If you look at Washington Union, Western Union, there we go. That's what I'm trying to say. If you look at Western Union, you can see that the multiples here, this business is traded at kind of like 8 times EBITDA, 11 times earnings, and kind of 2 to 2.5 times revenue. And so we then take those numbers and we apply it to our tab here, which has 3-year out EBITDA, which is this, put a multiple on it, add the cash they generate, and that gives you your upside. And so this is something that you don't almost never see from us. I'm assuming that this business in 3 years is going to trade at a higher multiple. That's because I believe they've hit a growth inflection point, and the market's going to give them more credit. I usually do this with a fair amount of trepidation because I am a conservative value investor, and I think building in multiple expansion can be a mistake. I just think this business is misunderstood, and the last 5 or 10 years is not particularly instructive of what the future is going to look like. So this is what we do here. Everyone might have a slightly different version of this, but we try to use 3 years out, take a historical multiple, slap it on there, and see what you get.
I have a quick question on that.
Sure, yeah, absolutely.
I might have missed it, but for cash generated, are you just adding up the NOPAT for that projected period?
So that's a good question. So it's actually just traditional cash flow, free cash flow.
Okay.
So just cash flow from operations minus CapEx. And so we sum that over 3 years, and we're kind of agnostic between where it goes. It goes to buybacks or dividends. We just think that or does it reduce debt? We're just assuming that goes into the shareholder's pocket in some way, right? Either net cash builds up. In some way, the enterprise value is lower, or there are fewer shares outstanding, and it goes into your pocket that way.
Thank you.
Good question. Some of the parts. So this is really for companies that have multiple segments. We find public comps for each of the segments, and then we apply those multiples across the segments. You can also use precedential transactions as well. So if in this case, this is Lumen, which is my personal largest position. But it's part of a business is a legacy CenturyLink business, which is a rural telecom. And there have been a number of deals in the rural telecom world over the last 2 years. And so when you're doing a sum of the parts analysis, you can take those multiples and layer on public multiples for the existing public companies, and when you're separating out the segments, and you can start to get a sense of what multiple would this business trade for if it was sold today. And then what I do is I add a discount or premium based on the business quality versus peers. So if you think that the company you're looking at is the highest quality business among all of the peers, then in theory it should deserve a premium multiple. So I would add a premium multiple for that company. Vice versa, if it's a mediocre business relative to its competitors, I would take a discount. You also have to be really careful if there are no perfect comps. Especially within a multi-industry company. If you're a multi-industry company as a comp, it's probably not fair. You want as close as possible. You want business models and margin structures that are as close as possible to have true comps. You also have to be aware of inflated multiples. If anything we've seen over the last 5 years is that multiples have expanded significantly. And so you don't want to be just anchoring to what the current multiples are, because who knows what that's going to be in 3 years. You want to be conservative on that fact. And so then you sum up the various parts, subtract the debt, and you get the equity value. This is actually from a Lumen presentation. This is not something we did. So in June 2020, Lumen put out a sum of the parts analysis. The stock was, I don't know, $9 or $10, and they put out, if you put a 10 or 12 multiple in the level 3 business, 5 to 6 multiple on the legacy CenturyLink business, you're getting 24 to 35 on a, I don't know, $10 stock. So for someone who held the stock, this is pretty instructive regarding what they think this company can be worth. But this is a good little quick analysis of trying, especially if they're good comps around, try to figure out what the sum of the parts would be worth for a company that has multiple segments. Private market value, it's not so different from a sum of the parts analysis. I mean, what you're asking is like, what would this company be worth for as a whole if it were sold today? And so you can look at precedential transactions, like I mentioned. You can do this, is basically the same analysis. You apply those multiples to segments of the whole company. You add a discount or premium based on the quality. But you always have to understand where you are in a cycle and when the deals were completed. If the last deal in this industry was done in 2014, that might not be particularly constructive. Or if you're at the bottom of a cycle and the earnings are depressed, well, then putting the multiple from a different time might not be applicable. So you always have to recognize where you are. And again, be careful if there know or few comps, and be aware of those inflated multiples. And then understand the differences in businesses. So you've done this work and you have a sense of the quality of the business, but remember that comps can be, that there's very rarely a perfect comp. And so the margins or the returns could be different. The growth profile could be different. Geographic exposures. You could have one that's all US and the other one that has multinational exposure. Where the stock is traded can be different. There's a rule of thumb that may sound counterintuitive to you, but US specialty chemical companies always trade at a premium to European specialty chemical companies, irrespective of what the geographic diversity of revenues and EBITDA and returns look like. Just because they trade in Europe, they've historically traded at lower multiples. So those are little things that you have to keep in mind. Scale and size can also be meaningful, right? A bigger company that has more scale and size may A, be more profitable, and B, trade at a higher multiple. And then who's the buyer? Is it strategic that can extract synergies, or is it a private equity acquirer who's just a financial transaction, who's going to lever up the company to get their returns, but they probably can't extract the same level of synergies? So at the end of the day, again, you're trying to combine valuation techniques. What you want is multiple metrics that suggest undervaluation. If one doesn't scream cheap, it's not necessarily a deal breaker, but it should raise, you should raise an eyebrow. Maybe that's not the right analysis for this company, but you should pay attention if they're not all pointing in the same direction. And you have to make sure you're consistent across your assumptions, in your assumptions across techniques. Like, don't use a 10% NOPAT growth in the DCF and then assume that this business is going to trade at 7 times EBITDA. Those things are not congruent, right? A business that's growing that fast will not trade at 7 times EBITDA. So make sure that you're consistent in your assumptions. And so in general, if you're too conservative, you miss opportunities. And honestly, I think I've said this to you before, but you have to come to grips with this statement. Throughout your career, you are going to miss a lot of things. There are going to be things that you looked at that you passed on that did really well, and you have to get comfortable with that. You can't let that affect you going forward. So you just be conservative and be okay with missing things, because if you're too bullish, you lose money. And the first rule of investing is don't lose money. And in general, you want to demand a sufficient margin of safety for the risks you're taking. And then, as you think about your analysis, going back to the qualitative part, again, the business analysis, make sure that your contrarian thesis on the business and the people is make sure you have that, and it's not, you don't just have a cheap valuation and that's all you have. You need to have a reason for why the business is too cheap or too undervalued, right? There has to be some kind of qualitative aspect that says this business is undervalued for this reason. Don't just rely on the valuation to tell you that this is worth investing in. People, this is something we've gone through before, so I'm just going to go through this very quickly because I cover this in my presentation. If you want those slides, or if you want my personal management scorecard, which is similar to some of the other analysis I've shown you, just let me know. But just very quickly, remember, when you're thinking about people, go back to that presentation, steal that checklist. But you have to assess prior capital allocation. You have to understand incentives. You have to see what has management hit its targets and goals. You have to look at how long they've been there and what their previous experience is, and how have the financial returns and results and stock performance been over time. I think you need to be skeptical and then make a call on management, especially in a short period of time. Most management's neutral, so that's your baseline. And so what you're looking for are outliers, people who are especially good or especially bad. And so assume they're neutral, and then say, friend or foe, based on the analysis that I provided for you in the previous lecture. Tony, you want to go with our second to last poll? So 71% of you believe that governance is the most important. I would agree with that, and that it has nothing to do, not to denigrate or demean the first two. But my general sense is you don't get good environmental and social sustainability without good governance. Everything at company starts with the people at the top and good governance. Good management teams anticipate changes and invest for the long run. And if you're going to focus on the environmental and social side, it's going to come from the top, and it has to be part of the culture. So for me, governance is the most important thing, and then that from good governance trickles down good environmental and social practices. And so if you're looking at a company, ESG is a really important topic. I mean, I don't know how much you guys talk about it, but it's a really important topic among institutional investors. And so it's going to be an important topic among investment managers. And so you're not going to be able to learn a lot about ESG in a short period of time. You really do have to follow an industry for a while and a company for a while. And so if you're time constrained, focused on governance. Go back to the presentation I gave you on governance, because I think that can be instructive, as to start with, to determine whether management's a friend or a foe. But there are some things you can do in the short run. If you have a couple of days, you can look on Indeed. Sorry, I should say look at Indeed and Glassdoor to get a sense for the culture. So look at the company's ratings. What are people saying about management? What are the people saying about work-life balance? Indeed and Glassdoor are great resources to get a sense for the culture. Does the company publish a corporate social responsibility or ESG report? If they do, that's probably a good sign, but that's not sufficient, right? Because there has to be some meat to it. But read through that. Ascertaining the environmental side can be really tough, right? I mean, there's so many different reporting standards. I don't even think most ESG investors agree on how to assess the environmental side. I'll give you just a quick example. Let's say you have a polluting company that's doing a lot to stop polluting, and the scores are really low. Do you reward that company or do you ding that company? And that's the nuance here of ESG investing, which is so tough. But I'm going to give you just a few things that you're welcome to steal when it comes to the environmental side. So here's some questions I ask myself about the environmental side. There are people way smarter than me on ESG. And they probably would have better questions than this. But really what it is for me, it's a red flag analysis. If you just see a lot of yeses here, you start to worry that a cheap valuation may not be enough to protect you from these issues. And you may start to question the longevity of the company or the returns. And you may wonder about management. Have they allocated capital properly? Have they risk managed properly? So these are not hard and fast rules really, but just as red flags. So if you see a lot of yeses here, you should start to think about whether or not this is the kind of company that's positioned for a world where the climate is increasingly more difficult. But the other thing to remember is that ESG is a very hot space, which means that every institutional manager has to answer questions about ESG. And that means that every company has to answer questions about ESG. So plenty of companies are greenwashing, which means that they're just putting out, whatever numbers and goals and targets and PR that is not really core or to the culture. So it's just something to remember. This is something that if you have more time to look at a company, this is something you'd spend more time on. But I do think that you feel free to steal these questions and ask yourself these questions, as you're assessing the environmental side of ESG. All right, so here we are putting it all together. One thing that we've talked tangentially about, but not directly about, is risk factors. But let me just run through, as you're thinking about making a recommendation and what to, how to, as you're thinking about the kind of putting together the whole analysis, you have to pay special attention to what can make you lose money. Not losing money is the first and the second rule of investing. And one way to do that is to be your own short. If you remember our process, we have a 2 long, 1 short process where for every stock we have a short analyst. So do that. Be your own short. Create 4 to 5 points for why this will not be a good investment. To be a good analyst, you have to be good at arguing against yourself. Remember, there are lots of ways to lose money. On the next slide, I'm going to show you some of our favorite ways to lose money. And remember that markets are relatively efficient. You have to have a good reason to be a contrarian, right? To be a contrarian, you buy the stock, you're saying that the market is wrong, right? That the market is underappreciating the future, right? And so you have to have a reason for that. And there's a lot of stocks that are cheap for a reason. So you have to believe that there's something different going forward to be able, to invest today. We always ask this question: would you rather buy Tootsie Roll, which is actually a public company? And the reason why it's just a very simple business to understand. So is the business you're looking at really complex, and does it have a difficult balance sheet and a bunch of JVs and a bunch of off balance sheet liabilities and all this stuff? Like, wouldn't you rather just buy Tootsie Roll? Because what does Tootsie Roll do? They sell chocolate, right? It's pretty simple. So this is our check on are you really getting too involved in complexity? Would you rather buy a simple business? My personal advice is to approach every investment with skepticism and humility. At the same, be skeptical, be humble. Look for reasons not to own the stock. There's always this, like, you get excited as a young investor or any investor, like, oh, I found this next great thing. You should always be arguing against yourself and looking for reasons not to own it. And if you're pitching a stock to somebody else, everyone always appreciates you highlighting the risk as well and arguing against yourself, because that means you've thought through the risks. But you also have to be optimistic, because stocks do go up over time. So this is a really tough balance, and why investing is so hard is that you have to be simultaneously, optimistic and humble and skeptic, and be a skeptic. Like, it's very tough. But remember, stocks go up over time, and if you're too bearish, you're going to miss a lot of good opportunities. So these, and I'm not going to go through these, but these are ways that we have lost money over time, and I account for these. But too high leverage, investing in a bad business, highly acquisitive company in a roll up, the new management story is a way we've lost money. Some new person comes in and says this, the other management team was stupid and we can do it better. And then it just, whatever, the turnarounds are really hard to do. So I'm not going to go through these, but just remember there's a lot of ways to lose money. And these are just some that have burned us in the past. And so at the end of the day, as I mentioned, you're developing a contrarian thesis. And if you're doing that, you have to have some independent thought. If you're just parroting what management or the sell side is saying, that's already baked into the stock. To have a contrarian perception that actually leads to good returns or above market returns, you have to have views that are different from consensus. And so what I suggest to do as you get to the end of your process, write down your narrative for what needs to happen for the stock price to be a lot higher in 3 years. Make sure you've identified the 4 key variables. What is your view on how each of those will play out over time? And if it's true that 10 things have to go right to make money, that's a red flag. So I love Michael Mauboussin, who's a great thinker and author, encourages investors to think in base rates. What is the base rate of success for this particular endeavor? So what is a base rate of success in an investment for which 10 things have to go right? So for other businesses that were in the similar situation and 10 things had to go right, how many of those companies made money over time? I would suggest very few, because just you want simplicity, you want a clear path to growth and margins and a higher multiple. You don't want just a perfect storm to happen for things to get better. Always think about what you're thinking that others aren't. What aspects of the company might be underappreciated? Is it possible to develop an informational edge? If you're looking at Apple, you're not going to have an informational edge. There are people who are better resourced than you, have more time than you, and probably been doing it longer than you. You're not going to develop an informational edge on Apple. But if you're looking at a 100 million market cap microcap company, then maybe you can. Maybe you know the management team. Maybe you understand the business in a way other people don't. So can you find a way to get an edge based on the work you do? And then, are there potential catalysts to value creation? Capital allocation changes, acquisitions, divestitures. Is there a catalyst to getting the value realized now? Tony, you want to do our last poll? So this was I think this is evidence that I've done a pretty good job in my presentation, because this is the takeaway I really want you to have. This takeaway is that being a good investor, and these are definitely not all of the traits, but you really need all of these at the same time. And that's, again, why being a good investor is so hard. You need to have all of those traits working simultaneously. I'm glad that was your takeaway. And let me just spend a couple minutes on this. I know we're about to run over, and I apologize, but let me just, because we do need to think about this process, right? So you were handed a task to turn around a stock in 48 hours, whether it's, you're going to turn it around and say, we should do more work on this, or you're in an interview and you need to make a recommendation. I would say this is how to think about making a recommendation. As I said, you shouldn't feel like you have enough information to say, buy this stock, right? Like that's crazy. You're not going to be able to do that in 2 days. But here's what you can do. You can highlight the work you've done. You can liberally steal from my process, and you can show the depth of your process. You can show how you marry the qualitative and quantitative side. And then you can go back. Remember the expectations that we talked about on the first 2 slides. It's impossible to get conviction within 48 hours or probably even a week. So don't make an investment recommendation, but you can, I think, after that amount of time, you can opine on the following things. Is this a company you'd like to own at any price? Yes or no? Does it appear to be trading at a large discount or not? If not, at what price would it be more interesting? Is this a business you'd be willing to pay up for? What do you think of the people, friend, foe, or neutral? What further work would you like to do to learn more? I think after 48 hours, you can answer those questions. And if I'm your counterpart, whether your boss or your potential boss, I think that's a pretty good, I think I would, if you can answer all those questions, I think I would be pretty satisfied with your work. And again, put yourself in the shoes of the portfolio manager, not just a stock analyst, as you're answering questions about this company, right? Like, how does it fit in the portfolio? What position size would it, do you already own a company like this? Like, don't just do your research in a vacuum. So I know I've run over, so this is just a couple more slides on other research avenues. Like, if you do have 2 months or 2 years or the rest of your life to look at a company, there's a lot more you can do. And so you can feel free to look through some of the things that we do, to kind of bolster this research. And so let me finish with our takeaways. So before you start the process, make sure you think about what you're being tasked with. Approach everything with curiosity and humility. It's okay to say, I don't know. Don't try to make up an answer if you don't know the answer. No one expects you to know everything as a young investor, especially not in 48 hours. Say, I don't know. That's a place that I will look for more information. Use checklists to establish your process. And as I've said many times, just don't be shy about stealing from other people's processes. Business value people. That's a good framework to start any analysis from. Think like a PM, not an analyst. Remember that markets are efficient, so you need to develop a contrarian thesis, and that takes time. And so you might not have that in 2 days, but what is your path to developing a contrarian thesis? And then successful investing involves creatively marrying quantitative and qualitative analysis while mitigating your own biases. That last point is just the crux of investing, and it's something to remember for the rest of your careers. I know we've run over. You guys asked some good questions. You answered some polls. I'll stop there.
Ben, thank you. Let's give Ben a big round of applause. You crammed a lot of information in there, Ben. So
I don't know how I did it.
you did. I don't know how you did it either.
There was a lot in there.
There was a lot in there. All right, everybody.